Hi folks, three mutual fund houses have launched a new product called SIFs or Strategic Investment Funds. Let's see what these are about. So, the three funds which have launched the SIFs are Quant, which has launched an equity only SIF, whereas SBI and Edelweiss have launched hybrid versions. So, these combine equity, debt, and arbitrage. So the first question is which ones to choose. Now, in my opinion, most investors already have a multi-asset portfolio because they have different versions like gold, FD, they have debt funds maybe, etc. So their portfolio already acts like a multi-asset portfolio. They may not require a hybrid version. Also, mixing equity and debt within one fund sort of muddles the performance of each of these categories. Now, if you have separate funds which are more specific in nature, then you can understand the behavior better and you can also control it better. In this sense, it could be that equity SIFs are more suitable for you. The thing to also remember is that the minimum investment is 10 lakh rupees for an investor or for a single PAN. So this means you're committing serious money into a single strategy. So you have to keep in mind while assessing these SIFs. The main difference between SIFs and regular mutual funds is flexibility. And this flexibility comes because SEBI has allowed these fund managers to use some strategies which are not available for the traditional mutual funds. One such strategy is the long short strategy. To explain this, let me use an example. Let's say that a fund manager believes that Infosys is going to go up in value and Wipro is going to go down in value. So at the same time, they buy 10 lakhs worth of Infosys stock and they sell Wipro stock. This is done using products like derivatives, which can be used to sell stock and then settle later. Let's say that in the first scenario, market rises. So Infosys rises by 10%, but Wipro also rises by 5%, even though they were expecting it to go down. Now, in the buy strategy, which is a long strategy, the fund has made 10%, but they've lost 5% because they had to sell Wipro at higher than expected. Net, they made 5% gain. In a second scenario, market falls. Let's say Infosys fell by 5%, but Wipro fell by 10%. So in the buy strategy, which is a long strategy, they lost 5%, but in the sell strategy, they gained 10%. Net, they gain 5%. So this is a simple example to explain how the long short strategy works. Of course, it is more complex than this. There are also risks involved. It could be that the fund manager makes wrong calls, therefore the losses amplify. There could also be risks like leverage risk, liquidity risks, where they can't get out of a position fast enough. Therefore, the losses can increase. In SIFs, fund managers can also use derivatives and they can use hedging strategies, but both within prescribed limits. This is to try and reduce losses in a volatile or falling market. By using these strategies, what are SIFs aiming for? They're aiming to give steadier returns. Now, for most long term retail investors, traditional equity funds are still the best fit. If you plan to stay invested for many years, then you don't need these complex strategies. Time itself is your best cushion, and this makes up for the short term market moves. In strong bull markets, also, you'll see the traditional equity funds usually outperform because they are fully invested. But in sideways or volatile markets, SIFs or long short funds can do better because they can adjust faster and therefore they can give you steadier returns. Even in falling markets, they are likely to protect the downside more. So, if you are a long term investor who is not looking for these complex strategies, then you can stick to the traditional mutual funds with your asset allocation mix and your diversification mix. But if you are an investor who has 10 lakh rupees, who has already crossed many of the traditional equity mutual fund categories, you're looking for diversification, you're looking for an extra strategy, and if you're looking for the ability to protect your capital during uncertain times, then these sort of funds could work for you. Typically, these work for family offices or for large investors. However, these funds are still new, they don't have much of a track record, therefore, the performance is still untested. I would say the real test will come when the markets turn volatile. So it could be wise to wait for a year before you commit serious money to these kind of funds. If you have any questions or need any further clarifications, do drop a comment or write into us at our contact points and we'll be happy to get back to you. Thanks for watching.